Yours? Wait, here we go. All right, we're live.
Now we're live.
Jason Sipple's doing the intro. What's up, Jason?
Go for it, Jason.
Hey, we're back for another week of Ask Me Anything. Every week since the pandemic, when we used to come here and have happy hour with you. Now we're a little bit more tame. We drink water, but we still answer all of your questions. We come back consistently, persistently, and we're glad you are here. We're going to do a quick 14-second intro. Then we're going to come back, go around the horn, and we want you to put your questions in. So let's get rolling.
We got to start that, right?
All right. What's up, Mr. Sipple? What's up, Mr. Fouts? What's up, Mrs. Tess? What's up, Linus? We got the whole team here. We got the BYOB Money Mentor team. We're ready to answer your questions. So get those questions over in the chat box. I was going to put the World Cup on and stream it while we're waiting for questions to come in, but I'm worried about copyright violations and the rest of it these days.
Worried about rules. Rules, Steven, rules. That's weird for you.
I'm following the rules for once. That's right. So, but just as an update, 75th minute right now. England's up 1-0. Argentina's pressing hard, trying to make it to the final against Spain on Sunday at 3 p.m. Eastern. So it's been a fun World Cup. Anybody been watching that? Any favorite teams? Is your team still in? I guess if it's Spain, are they out? What do you got? I don't know. What questions do you have? We got Larry Resendez, 1625, saying hi. What's up, Larry? So get those questions in. Let's do a little quick around the horn. So my name's Stephen Nagy. I actually hosted the wealth webinar today with Craig Yenny, which was a lot of fun. Had a great conversation around infinite banking. And then we got into a little bit about how cash flow is different than net worth and having lots of assets, and how somebody can have the same net worth but have completely different lives and financial situations. And it's pretty interesting. A lot of it boils down to control. Do you control your money? Do you have those options? Are you giving up control and getting penalized for using your own money? So check out the wealth webinar we did today. It'll be on the YouTube channel right here, YouTube at Chris Naugle, on Saturday. So check that out. With that said, though, we got a lot going on this week, a lot happening like always. Appreciate all of you being here, watching. Get your questions in over in the chat box, but I'll let Mr. Brian Faust do a quick introduction.
All right. Hey, everybody. Brian Faust here up in North Idaho, wearing my Hawaiian shirt that was actually bought in Hawaii. It's feeling festive. And I got a new hat, just came in about an hour ago.
Nice.
Whisper.
Crawfish Whispers. My mom and dad had this specially made because one of my biggest things that I do around here is go crawfishing fishing with my son. And we just had some traps that got lost and taken. And so they just sent me a couple new traps and some new hats. So it's kind of cool. So we're going to go out and put both traps in the water here probably today. It's a lot of fun.
Very cool. Very cool. Maybe they weren't taken. Maybe a bear got to them and ate all your.
Yeah, not in 25 feet of water, probably.
Wow.
The polar bear maybe, but yeah. So we're gonna go take the boat out and stuff and go have some fun here today. But yeah, with that, I'll pass it over to. Let's go to Jason.
Thank you, Mr. Fouts. Like the new hat, bro. That's cool. That's a big crawfish, big as your hand on that hat. So
my biggest one is half a pound so far.
Wow, that's a big cross, like a lobster versus a crawfish.
12 inches.
So I'm here in City Beautiful as always, enjoying. There's no thunderstorm today yet, but it's early. Probably will get one. Just happy to be back every week with you, all of you. Bring your questions and let's see. And your favorite teams too. I like to know who you're rooting for. Every one of my favorite teams has gone out, whether I was rooting for the U.S. or my wife's team, Ecuador. And then I was rooting for the Vikings because I like the rowing and Holland. And now we're down to Spain. So now I'm rooting for Spain. So I'll just keep picking a new team. Now I'm going to go over to my friend Tess. So hello, Tess.
Hey.
How are you?
Good. How are you guys? Tess Hulek. I am from Detroit area. Actually, around here, we're having a lot of dealings with the smoke because there's some Canadian wildfires. And I tried to walk my mom this morning and the air just wasn't a good enough quality. But we are glad to be here, ready, willing, and able to answer your questions and looking forward to helping you get started or continue on your journeys. And now, my partner in crime, Linus.
Thanks, Tess. Hey everyone, Linus Nolt here from Hopkinsville, Kentucky. I don't partner in crime, but yeah.
I don't crime either.
Right. But yeah, I'm happy to be here in the AC today. It's another hot one here in Western Kentucky. I'm happy to be here and help answer any questions I can. What do you want to know?
Yeah, get those questions in the chat box here. I'll kind of touch base on what Stephen mentioned here at the beginning about cash flow. And so this is a question I've been asked before, and it applies to something I've been doing recently. It says someone will say, hey, would you rather have $1 million today, pure cash, or $65,000 of cash flow for the rest of your life? What would you rather have?
I want to know what kind of guarantees are attached to the 65 a year, but man.
Just assume it's guaranteed. That's it.
Right.
What would you rather have? $1 million cash or 65 for the rest of your life per year? Jason, what would you want?
Oh, right now, if I had $1 million, I would put that money to work and have that money making me more money. I think you can make more than $65,000 a year off of $1 million today, right? If you got 12% somewhere, right? Or if you put that into a policy and borrowed it out and even got a simple 8%, you'd have more than that. So I'm tending to go towards the million just from thinking.
Yep.
You're going to tell me why 65 is the right answer here in a second. So.
No, it's a age dependent is a big issue with it, by the way. So Linus, what would you do?
I would take the 65 guaranteed a year. I certainly would.
Yep.
It only takes a little over, about 15 and a half years for 65 a year to total $1 million. And for that to be guaranteed for my entire life, just having that base of 65 a year guaranteed for maybe the next 50, 60 years. Shoot, I probably live past 100. How long is that? That's over 70 years.
Yeah.
I'd certainly take up that guarantee in my life.
How about you, Tess?
Well, I'm going to be 100 in a lot less years. I don't know. I think they all sound good, but my life expectancy is a lot shorter than what you guys are talking about. So give me that money now and I'll make it work for me.
There you go. Yeah, because I would take the probably the 65, because if I combine that with earned income, all of a sudden you got so much more coming in, and my base expenses are covered. I don't have to worry about money anymore. Realistically, I don't, because your base expenses are taken care of, and that to me is a big deal. And so, why this comes up is because it's a question I've heard many times from just financial advisors, but it's an annuity does that. And so I was doing the math on this here today with a client, and they were going through the $1 million or that. And then we did the math on it, saying, well, wait a second, the annuity provides the guaranteed income for life. They don't have to worry about money, but they can go do their job that they enjoy doing and not have to worry about money anymore. They're like, oh, that changes things right there all of a sudden. And so it makes a lot of sense from that perspective, if you're not really wanting to go do things like investments, which involve risk. So it's kind of interesting. It's an interesting question to think about. I've got a couple of clients right now that are doing though. That's what they're doing. They're saying, oh, okay, I wanted to take the money off the table, no risk, and go do something I enjoy, but not have to worry about, earning income for expenses. So
Brian, I have a question in connection with this. Have you run the numbers on what the immediate annual guaranteed income would be if $1 million was put into an annuity today?
Depends on the age of the person and gender. Bro. So the older you are, the higher the return. So for you, it would be it'd probably be like 5%. For Tess, it might be 7%, as an example. But yeah, so it's getting right now on the last one I did, it is 7.5% guaranteed. Now, is that the growth rate, or how much of it pays out per year? How much it pays out per year? It's actually a bit more than the stated rate is 7.5, but the actual cash flow is more. It's kind of a weird thing. It's because it's an index product, but they're really kind of cool how much income they're providing. But what we talked about on the last Wealth Wednesday last week was the 4% rule. And the 4% rule says that if you have $1 million in your 401k, take out 4% maximum per year. That way you'll have enough money for life, maybe, hopefully, right? But that's not true anymore. So the last time I had an advisor say this, they had said, no, it's now 3%. It's going down, not up. Instead of 4%, which used to be the standard, it's now 3%. I heard someone say 2.5%, but it's kind of weird. This is happening right now with a lot of my clients. They have a 401k with however much is inside of it, and they're doing the math on it. If I take out 4%, I'm going to be screwed down the road because it's going to go to zero eventually. They go put that same amount of money in an annuity, and it gives you guaranteed 6% for life. It's like it's almost a no-brainer. Like, why would you not do that? Because you're going to run out of money with a 401k. With annuity, you won't. It's crazy. I don't understand why advisors do not like that. They don't like that.
Well, it's maybe less money under management is depending who your advisor is, or we like to solve problems with the way that we're used to solving them today, and it doesn't always work. So now you're looking at a much higher interest environment, which is why you were so excited about, because you're not getting 2 years ago, you weren't getting 7.5%, right?
No.
Or even a year ago. So
no, it was more like 4 or 5% or something like that. It was a little lower. So right now it's a really higher environment, high interest rate environment. So yeah,
it's all I hear you talk about now: crawfish and annuities. So
yep, exactly.
And summer school. Don't forget about summer
school.
Yeah, it's a little crazy.
I like how we slid that in. 2 things you're happy about, 1 thing you're not so happy about. And
well, it's done this Friday, thankfully, and then we're going camping this weekend, so that'll be great for that to be done. But I'm going camping with 5 kids. It's like, yeah, it'll just gonna be interesting.
How did you get extra kids?
We have a cousin from Alaska visiting for a month, and then my daughter's bringing her best friend. So
nice.
It's gonna be interesting. It'll be fun. It'll be good at times.
They can entertain each other. You'll be okay.
Yeah. I'll have my Starlink, so it'll be good. All right. So anybody who's on, to get those questions in the comment box. Otherwise, we're going to keep talking on different topics here. There was some questions that did come in on the Wealth Wednesday that I wanted to address here because I didn't answer them on that.
I have a question here. I'll look up too in my email. So pardon me looking to the right, but I'm going to find a question.
So this is a good question we get quite a bit. It says, will a policy, infinite banking, by the way, work if you are over 65 years old?
Yes.
Yeah.
Wait, what was the question again?
Can it work if you're over 65 years old?
Yeah.
Yes, you're just in the middle of the 3rd quarter, people. Come on.
There you go.
Every week, right? 1st quarter, 30 years old. You guys agree with this analogy? Because I know I'm the one that always tells you what it is. Football, basketball, whatever you like. Quarters. 4. What's that?
I do 4 quarters in life.
Okay, 4 quarters, but we got a halftime. That's why I like to use football or basketball. So we do the 30s as your 1st quarter, your 40s is 2nd quarter. I'm in halftime. That's why I like this, Brian. So I'm in halftime. Your 60s are your 3rd quarter, and 70 to 75 is your 4th quarter.
Yeah.
So
I would do it in increments of 20. But
yeah. 50.
Yeah. I mean, you can do a policy when you're over 65 years old, just depending upon income and cash flow and insurability. Of course, those all come into play. I had a client right now that wanted to do one. He was 78, that is male, there was just nothing we could do there. No options there. I have my oldest client, I think, is 75, female, that had a policy that worked and had good numbers. I did another one on someone who was 71. Numbers were really good. And it's very company specific, by the way. So I've had a lot of clients where they will come to me and say, hey, Brian, I went to Bob, my insurance guy who's captive to this insurance company. Maybe it's New York Life or some company. And they do a policy at 70 years old or 71 years old, and it sucks. It's like, oh, it's horrible. And then I go show them another policy from a different company, and they're like, it's night and day. It's because of a different company. So when you start to get older, you start to kind of narrow down the number of companies that you can work with, in my opinion.
I was looking at some attractive options for 78-year-old a few weeks ago. I think, Jason, I was texting you about it. So if you want, Brian, I might just take another look at that one.
What carrier was it?
One America.
That's 78, huh? Yeah.
So you run that with a different rider, an EBIR rider on it? Is that how you did it?
No. It was way more efficient without any term, just doing a monthly premium to where there's no term needed, and you can still do, say, the max split of 75, 25. You can do some pretty cool stuff and potentially dump in some extra in that first year as well.
The reason why I didn't move him forward, his fixed income. And when really low income, I mean, and the premium was way outside of his range. So
I got one for Linus. A question on this. This is more probably we're just here and we're together, so I'm going to ask the question versus, hey, 1-to-1, it's 1-to-1. All right, we got an update. Argentina seems to get up when someone steps on their throat. They're ready to fight. They come back. Huh? They've done that in the last couple of games. So, Liz, my question for you, or not really question, just observation, is I worked with a woman today who 73, her husband's 69, and his term is running out. He's not on board with this yet. She really gets the math. She loves it. She's bought the book for her son-in-law already and everything. And so she wanted to see, well, she's like, well, hey, I don't think he'll like putting this much into a policy. So what if we just do the base plus the PUA attachment, right? So the minimum you could do to add more paid up additions later with the One America we just talked about. And to end up to not mech it, I added like $50 a month in PUAs versus 10. Otherwise, it kept meching. It was really weird. I didn't know if it was an age thing or it would have needed a rider. I'm not sure. So, like I said, maybe this is a separate conversation, but that was an odd thing that happened today.
I think something that Brian said is kind of interesting that we don't talk about often either, is that he was talking about a captive agent, and a captive agent means they can only write for one insurance company. We are appointed in multiple companies, for some of us up to 6 companies. So we can choose a company that may be more beneficial to a particular client.
Always we're trying to solve the problem in front of us and what is most important. So when you're clear, when you come first, 2 points there, when you're clear of what you want, like after digging almost a 45-minute conversation, it became apparent like legacy was the main thing first. There wasn't a cash flow problem. There wasn't a problem with needing to make major purchases or going and doing an opportunity fund. Those were all things that were cherry on top to them, but it was legacy, protection of the grandkids first, right? So, and then you start going, okay, well, I'm going to go with this carrier, and then I can build it this way, and I can build flexibility into it and those type of things. So.
Yeah, Jason, that may be a conversation for somewhere else, because I think it's really just a thing in the designing software that we use to build policies. I don't think it would have been realistically a Mac one way versus the other on that specific design, but we can take another look at it.
Okay, awesome. Cool.
Oh, goal!
Another one?
Messi with the cross in the header right into 2-1 Argentina.
Wow.
Holy cow.
Wow.
Next time you're on the desk, Stephen, dancing.
Wow. You gotta extend it a lot longer. You gotta extend it.
Anybody else watching? What do we got going here? Is there a video that shows? Okay, we're doing good. All right. Sorry to interrupt.
No, that's more fun than we're doing.
Back to
We're
our
talking about mechs and you know the usual stuff. So yeah, and having the choice to go to multiple carriers and things of that nature. So
yeah. All right, we got one question here. We'll address this question from Charles. Says, is there a video that show how to do this if you can't qualify for a policy? There's quite a few responses to that question.
It's actually, it's one of the most watched on Chris's YouTube, and I made that video as well, and it's one of the most watched on my YouTube as well, which is kind of odd, right? It's just about how it's the motion of the money you're using, and you can use other things. So
yeah, so
not as optimal as this, but Brian's going to tell us what he wants to tell us here.
Yeah, well, I agree with you, because I mean, there's more than one engine for infinite banking. Whole Life just happens to be the most efficient engine for this vehicle. But you can use cash, by the way. It's once again just not very efficient. You can use a 401k loan as another example. I've even had people that use like a kind of a line of credit, kind of like it but it's not the same. But there's more than one way to do it. But it really depends upon what you're trying to accomplish with it. Because depending on what you're trying to accomplish, infinite banking might not even be the best strategy for what you're trying to do. Depends on what you're trying to do. So, and then also, why do you think you wouldn't qualify for a policy? Another question I'd ask. And then, of course, who else in your life could you get a policy on? So do you have someone else who's insurable that you could be the policy owner on or something like that, or use the policy and get the same result? So, yeah, lots of different ones.
Lots of variables. I heard lots of variables.
Lots of variables. I have a question that came in here on Wealth Wednesday. It's a good one. Says, this is from Elizabeth, and she says, I am interested in buying a multi-dwelling home with a VA loan. How would it work with a HELOC? Amy, want to venture a guess on that one?
I don't actually know the answer. So
It's going to depend on the on the bank that's offering that first position HELOC in order to make the purchase. The ones that I've seen so far, none of them are going to go above a fourplex, but there can be some options to that. As far as the way the HELOC works and maybe the way that you're going to use it for maybe the velocity banking strategy, none of that is really any different to my knowledge.
So with the VA loan, you can use a VA loan to buy a multi-unit dwelling, but there's some limitations. Can only be up to 4 units, and you have to live in one of the units. So that's for the VA side of it. Now, if you're trying to look at a HELOC and a VA loan, HELOC and VA are 2 separate strategies. So like if you're just doing the VA loan, you could do that. And then if you're going to fix up the dwellings and then create equity, then you can go get a HELOC. And then now you've got a VA loan and then a HELOC in second position. Do velocity banking with the HELOC to get rid of the VA loan quicker, as an example. So it depends on what you're trying to accomplish. And if you're trying to purchase it with a HELOC, you can do that, but it's going to be bank specific. Make sense?
Yeah, it's also going to narrow down the options of which banks you can use, depending on your previous point of whether you're going to be living in one of the units or not, because it's either owner occupied or it's not, and that makes a difference for which bank is able to offer a revolving line like that.
Yeah, you can do that. So it's just, you just got to, you got to look at the bank, and there's going to be a lot of qualifications, that kind of stuff. Down payment still is going to apply. They're going to look at your credit the same way as a mortgage or a VA loan is going to be involved. But yeah, so it can be good if you understand velocity banking. But it can work. You just got to do the math on it. Yeah. All right. Any other questions we got coming in so far? No questions. Where are the questions at today, guys? Let's get them in.
Do we have many on today? Summertime. Yeah. It's like everyone's on vacation.
Yeah, that is our summers do slow down a bit here. Let's see here.
Yeah, I think it's across the board, right? How was Wealth Wednesday today?
It was good. It was a general, just kind of explanation.
I mean, like numbers wise. That's what I was wondering.
Oh, same. We always get about 100 people on.
That's a lot of people.
Mm-hmm.
I noticed that my webinars during the summer usually go from 25, 30 to 15, 20, 22, something like that, and then they come back up. So people are traveling.
Yeah.
Oh yeah, for sure.
I've got a bunch of buddies in Costa Rica making me jealous right now. Keep sending me pictures from the beach. So
yeah. This is a question we haven't had in a while. So Night Gamic says, can we do something similar in Europe?
You can watch the video on how to do it without infinite banking or without whole life insurance. So,
and then his follow-up here is, or their follow-up is, or are creating such policies specific to the U.S. So these types of insurance companies are specific to the U.S. and Canada. So yeah, so it is up. It is in Canada as well. It's a bit different up there because their taxes are not as good as the U.S. The tax benefits, I should say, are better in the U.S. Which I can't believe I'm saying that, but it is. But yeah, these companies only do this concept in the U.S. There's been talk about like Australia at some point, but currently not so far. Yeah.
Yeah, and I'll just put this out there: if you have a sufficient interest in the U.S., as in you have a U.S. bank account, maybe a business in the U.S., or spend quite a bit of time in the U.S., or you're a citizen living abroad, some of those bring in options to actually get a policy here, but not just the average foreign citizen.
Yeah. Yep. Let's see here. Anton is saying, I want to sign up for your Vault courses. When do you have those? So they are every other week, usually on Thursdays at, I think it's 7 p.m.
7 Eastern. Yeah, 7 Eastern.
Do we have a link to that? Because there's no like registration. They'll just send you an email with the actual Zoom link is how they're doing it. I'm not sure how to do that list.
You get access to those if you've signed up for the vault itself. I believe that's BYOBvault.com. Sign up for the monthly subscription for the vault and get in there and play with it. And that gets you on the list for notification on those weekly Zooms, every other week, I should say. We had done a few without signing up for the vault. You are able to watch a couple of videos there just off of the homepage, a demo and some other things. So check that out. You can.
And once you are a member, all the prior weeks are saved inside the vault, so you can watch those as well.
Yep. Let's see here. Another question that came in. Do you need a policy to pay off your debts?
No, definitely not.
No.
It's prettier.
Definitely not. You just use math, right? You can take the plan the banks want you to follow, which we kind of named the no plan. Or if you do math, you'll end up doing a snowball, which means smallest debt to largest, an avalanche, highest interest to lowest, or the cash flow index, which uses a little bit more math to figure out the ratio of your debt. And then you go ahead and figure out and pay it that way. You'll save interest in all three of the latter math ones I just named. What you won't have at the end is you won't have cash value and you won't have a guaranteed protection death benefit. So,
Yep. Yeah, I mean, a policy, it depends on how you're paying your debts off. There's a lot of factors that go into that. That's why we have software that maps it out, because it's complicated. But I mean, just as far as why a policy can be more efficient, it's because the policies are low interest and most debts high interest. And that interest is what really just kills you and just takes that time to pay them off. The policy's interest is lower interest, and also it calculates the interest a bit differently than like credit cards and car loans, things like that. And then Brent, you're saying put Harrison Graham. Do you mean Harrison George?
Oh, George, yeah.
Harrison George is contact info. Yeah, that person was on Wealth Wednesday, so I'm not sure who it was that asked that question. But yeah, it'd be Harrison George. So with
CMG
Financial, bank. Let's see here.
A quick observation though. One of the reasons I think people are really surprised is our money pattern doesn't have us paying ourselves first. So every time I show someone even flowing 10% of what they make into a policy, even if it's kind of conservatively designed, right? Like even if you're doing 35 or 40% base, you're still going to pick up, depending on how big the debts are and how many, you still end up saving more time. And it's only because you're changing where the money went first, which is the first claim we make in every single video. Like change one thing where the money goes first and everything else works better. It's because of the behavior change is why, right? And then if it's specially engineered in a way that's properly engineered, then it works the way we show you. So
yeah.
I find it surprising that people get surprised that, oh wait, paying myself first is going to change everything. Well, why have the elite been paying themselves 38% since 1910? Because it's really that important that you have to have your money go make money for you.
Right. 100%. So with Kathleen is saying here, my health currently does not qualify me for a policy. Companies say try again in a year. Yep. Are there any guaranteed issue policies you would recommend? So Kathleen, knowing your situation, we got to kind of wait because of what they've done, but we can always, as we've done before, go to other companies. But they're going to know that you had a policy denied if it was denied. But every company does have different underwriting guidelines, as we've discussed before. So once we get to that point, what we would want to do instead of going and getting a denial is go through preliminary underwriting, and then we can go ask all the companies again and just see if there's anything that they would consider. But
do you know if all the companies have been asked already or as of right now?
I'd have to go back and look at my notes with Kathleen. They have a policy. So her husband has a policy right now. So they're working on it. And then we also have an annuity quote, I think that I sent over to you, Kathleen, that we got to discuss a bit more as well. But yeah.
Because a decline doesn't necessarily keep other companies from offering, but it's just, we want to check them, which Brian will do for you. As far as guaranteed issue policies, they don't work for infinite banking, but just from a legacy standpoint, having that death benefit in place, it could make sense.
Give me a small death benefit, usually. But,
yeah, Chris Seeger. I know. I'm
and Chris,
I'm trying to come go check your underwriting.
Yeah, and then Chris, you texted me. I'm trying to get some time. We can chat today or tomorrow. Tomorrow's going to be a lot more open for me.
I was wondering if you guys connected yet.
Yeah,
I actually thought about that this morning. I don't know why, but it popped into my brain. So
it's been a crazy week with lots of, because I have 5 kids in my house right now, and I'm the only one here, only adult. My house is not on fire. Yay!
That's a win. That's a win.
That's a win for me right now. Oh my goodness!
Not even the spiders will visit.
I've had like 3 or 4, 12, 13-year-old boys here for a period of the time every day this week as well. They go to the ninja camp during the day, and there's like new kids coming to my house every day. So we've become the house that people hang out at. So
yeah.
So I feel your pain a little bit, Brian. It's like I'm sitting here trying to think and run illustrations and answer questions, and it's just like all I hear is people playing Fortnite and going crazy. Like, all right.
10 years from now, you'll wish it was
stick in the
bad.
mud, Jason. Stop being such a stick in the mud.
Yeah, you'll miss it in 10 years.
Yeah, 100%.
Yeah, just ask Craig, because my wife and our family stayed at their house for a couple of days last year, and Craig and Gina certainly, missed that activity from years ago, having kids around.
Yeah.
Great.
Larry's got a question here. It says, what is the smallest amount I can begin to save with? Now, I think you're saying, what is the smallest amount you can start a policy with for infinite banking? I'm guessing, if I read between the line. So
between the line, yeah. I like it.
That depends. It depends on your age, and it also depends on health. It also depends on, kind of what the most extreme illustration we can come up with as far as the smallest amount. Generally, as a rule of thumb, we're going to say 10 times your age monthly. So if I just, say you're 40, that's 400 a month, 50, that's 500 a month. It's the minimum that's going to work from a design standpoint for infinite banking and have a high early cash value. There's some flexibility possible there.
Yep.
I mean, right with that. I mean, once you go to 60, like if we're going to use that as our parameter, I don't like that one. And I share that all the time, and I'll say why in a second. But I say if you're over 60, then you're doing 15 times. Over 70, same thing. Just because you have less time in the game, right? So I think more needs to go in because you have a shorter period of time to really fund the policy and get money into it. I'm going to go by the simple rule, Larry, that it's at least 10% of what you make just following the first law of wealth. What I found, and it's a behavior thing again, what I found is when people can't do that, it typically means that down the road, like the majority of people who have surrendered policies I've helped has been because they've done less. And it's the first thing that goes because it's not a priority. And it's just something I've seen over, having over 500, almost 600 active clients. It's usually the smaller ones that are struggling to get the money in there that end up with the ones that surrender. I don't know if that's true for everybody, but that's been a pattern I've seen. So.
Yep. All right. Catherine's got a good question here. She says, can you discuss deferred annuity versus funding second policy with 100K? Number one goal now is retirement income. We want to retire in 10 years. Well, Kathleen, knowing your situation, the annuity is going to probably be the best fit for the income because you could defer it for 10 years and it's going to grow that annuity every single year for the next 10 years. And it's going to grow at a very good clip. But you could also turn the income on at any point during those 10 years if you wanted to. So it gives you a lot of flexibility, whereas a policy is not designed for cash flow. It's just not. So you have to go create the cash flow with the policy. But since you guys already have a policy that's working for you right now, and you want to, and the 100K I think is an inheritance, so it's already been taxed. So that way, when you start getting the income, only a certain percentage is going to be taxed, not the whole thing. So.
I kind of look at the annuity and the whole life policy as for different purposes too. Like your annuity is that tool that's going to provide you that guaranteed income for the rest of your life. As long as you're alive, that check will come in. But the whole life policy is a shorter duration. You're building it up, but if you die, the death benefit pays out. So it's kind of like two sides or two different uses for it.
Yeah. And I think, Kathleen, I think we did a 10-year deferred on the quotes. I'll have to go back and look. But maybe we need to have another conversation on that. But because here's the other thing too, is you don't have to use all of the 100K, right? You could use a portion of it as well. You don't have to use all of it. You could use a portion for an annuity, portion for the policy. But when looking at annuities, you also got to look at 10 years down the road, what other income outside of the annuity are you going to have at that point in time? Because you got to start doing the math on that. And I don't know if we did the math on it on our last call, but let's go ahead and do that next time so that we can understand what kind of income do you feel that you're going to need down the road. How would a policy do that versus how would the annuity do it? Because I'll just be honest, a policy that's growing over 10 years is not going to be far enough along the road where you can start borrowing from the policy for income. I mean, in my math, it's usually 20 years or more before to start creating enough growth in the policy to create income. Because keep in mind, this is why, a policy can be good for retirement income, but I like an annuity better, to be honest. Because when you start borrowing from a policy, what's happening to your cash value that's available to borrow? It's going down. If you're taking out more than the growth every year and interest on top of it, decreasing balance. And so it's not a finite number of years you're going to get income from a policy versus annuity. It's as long as you're alive and your spouse too. So,
and you can take that income from the annuity and fund it into your whole life policy.
You can, but if you need that for just pure income, then it might not make sense. But
something else you could look at is the existing policy. I guess on her husband, there's a good chance it has a MEC limit high enough to be able to fund in more. Might just have to go through renewed underwriting to kind of allow that extra amount. So that would be another thing to look at, is if there's a need or a want to build up more cash value, that could be a place to do it just inside the existing policy.
Yep. And also it is One America too, I believe so, which is good.
Oh, okay. So that would operate just a little differently from what I said. In this case, if it's a One America policy, it's as simple as just asking how much extra premium can this policy take right now without becoming a MEC. They'll get back to you with a quote, typically within a week, and there you have it. You can put in some extra. I mean, not always, but there's a good chance.
Yep. Yeah, Mrs. Summers with a house full of teenagers.
There you go. See?
When they go stay at someone's house, I kind of like it. I'll be honest. So Larry's asking a good question here. Says, can I start a policy on my daughter? She's in college. So Larry, 2 questions for you to allow us to give you a better answer. How old is she? And is she a dependent to you? So anybody want to take that answer though?
Yeah, and then if she is a dependent to you, do you have life insurance on your body? Is there life insurance if you have a spouse on their body? Because that is going to determine how much your daughter can have on her. And then if you're not claiming her as a dependent and she's independent, then that changes the variable of can you own the policy on her, right? Unless you can show there's an insurable reason. So, and Larry, you might be thinking that it's cheaper to get it on your daughter. I hear that all the time. So I'm making an assumption here, but I hear this all the time. Like, I know it's going to be cheaper to get out my son, or, from someone that's a 40 or 50 or 60, it's going to be cheaper to get out my kids or my grandkids. But because we're doing life insurance, I know we're talking about banking, but they're looking at it from an estate planning perspective. So they're saying, well, why would you protect, your daughter or your son when you don't have a policy on yourself? Like, Is something going to happen to them? Like, to be a little bit, fun about it, but something, hey, I'm going to pick the middle kid out of my 3 kids I want to insure. I had someone say that the other day. This is the one that's going to have the most problems, so I want to make sure they have insurance. Like, okay, well, that's not going to work like that, right? So it's not cheaper to have it on your kids, number one, if you're insurable. And number 2, it brings a lot more variables to play. We can do it, but you just got to be ready to get them on board and everything else too. So,
and I always say cheaper means, in people's mind, means smaller premium deposits, But that means also it's not going to grow nearly as fast or be very as efficient as quick because you're not putting in. It's like, hey, if I have a savings account and I put in $1,000 per month versus I put in $100 per month, you're going to have a very different amount in a year from now. So it's not necessarily cheaper. It's just it's structured differently. And then he says, my son has a policy for his daughter and himself. He's an agent. Well, yeah, because it depends on how old. Well, if he's your son, I'm going to guess that the daughter, your granddaughter, is under the age of 18. So he has to have a policy on himself as long as he's insurable before he can get a policy on her. That makes sense. And yeah, so he's correct. So, okay, if you're a stroke victim, if that may mean that you might be uninsurable, like you mentioned before. If you are uninsurable, then you can get a policy on your daughter, by the way, because you're uninsurable. And if she's a dependent to you, then your income and your insurability can sometimes pass to her. But once again, I'm going to put a link in here in just a moment. I would recommend you schedule a call with one of us to go through that situation because we're going to have some more questions for you. Was forced to retire. Okay. Also, like if there's a spouse involved, the mother's involved as well, that can also be a point we got to discuss as well. But good question there. Good questions. And you love this, Linus. I don't need your link this time. I remembered what it was.
Well done. Well done.
I'm so proud of myself.
No, that's not the link.
Where'd that one come from?
Yes, you do.
I don't know.
I need help with it. I have it right here. That's crazy. Anyways, let me do it again. Don't click that link. That's not going to go anywhere. That was for the vault, by the way.
Yeah, I saw that. Hey, you're doing better than me. I got a little, man cold going on here, and I don't feel terrible, but my brain is not working. So
I've never heard of a man cold. It's like a man bun.
Yeah, I was gonna say man flu, but it's not the flu. It's just like a little cold and grumpy and tired and all the stuff. So
yeah, Brian, that's not the right link either. I think there's supposed to be -RR after it.
It'll still work.
Yeah, it'll work, but it won't go to the right round robin. That's all.
Linus, you better get that to him. Help him out.
I tried.
It's fine.
I have them all saved.
We go further together, Brian. We go further together.
Yeah. They're all saved in my thing. But the question that came in, this is an interesting one here. I wanted to share this one with the group here. So my first goal is to consolidate all in one. So an all-in-one HELOC I'm referring to pay down debt. Second goal is to have whole life insurance if it's affordable. So the question she's asking is, should I schedule a call with you guys first or try to pay down the debt first and then come back to infinite banking?
Depends. It depends. Depends what's most important to you.
Yeah. But there's a lot of questions to that question that we'd have to ask to understand what's going on to give a good answer, unfortunately. So yeah, it's a good question right there. But yeah, there's just a lot of stuff we need to ask first.
Here's one for the panel. So I got this question throughout the day until I finally got to the nuts and bolts of what the client was actually wanting from me as terms of an answer. But it started with, hey, Jason, I'm putting 12%, and I already knew this because I had a strategy call with him. I'm putting 12% into my 401k, and I get a 6% match. So I reduced it to the 6% match. And he has a lot of debt, and high interest debt. And he wanted to know, do I keep contributing to my 401k or do I put the money into the policy? What says the panel and why?
Wait, so should I put it into the 401k or put it into the policy?
Should he keep putting the 6% that he's getting the match on into the policy while he has high interest, or into 401k while he has high interest debt sitting out there?
How old is he?
Like 38, 39.
I wouldn't.
And I think I would wonder how much money does he have in the 401k? Could he take a loan against it and pay down that debt?
Yeah, I'd have to do the math on it, because if he stops putting it into the 401k and puts it into the debt, how much is he going to save on in interest over time? And then could he bump up the 401k later on to catch it back up because he's got more cash flow now? You know, the other way I would look at it as well as this: what's the balance of the 401k? How much is it? You know, the balance is of the 401k?
Not off the top of my head. I could look it up.
Because a 401k loan at 7% might be a lot better than 22% on a credit card. So do the best of both worlds: borrow from the 401k, pay off the high interest credit card debt, pay yourself back. Now his 401k is growing because he's paying it back with interest.
Would you keep putting 6% in too for the match?
Why not? It depends on what his overall goals are, though, right? Because it's you know, obviously a 401k is retirement, but a retirement is a multifaceted approach. It's not a silver bullet. So there's a lot of questions, of course, to that answer, but that's where I would look at it, is just do the math on it. Because I've had clients do that, and they didn't even, like, I had a client did not realize that they could borrow from the 401k. They didn't know that, first off. They had a bunch of high interest debt, lots of it.
Yeah,
they borrowed 50 grand, paid off a whole bunch of debt, took that cash flow, and that's what paying back the 401k. Their cash flow didn't change at all, but their 401k is now growing faster because they're paying it back with interest, because the market wasn't getting them a great return. And so when they did the math on it, they're like, oh my gosh, they didn't know that. And their financial advisor didn't even talk to them about that, of course. So
lots of options. I basically went back and forth with them all day and just said, listen, because this is how I honestly think about it. This is how I would do it. And it's different than what Brian just said slightly, is I look at, if you're paying high interest and it's credit card debt, so it's high, like 20+%,
right,
and it's a guaranteed interest that's leaving your family every month, right? And it's causing a lot of stress in the family. It's causing you to feel a certain way about work and life and your kids and all this stuff, right? Like there's underlying feelings about the stress, but you're taking care of your future self. You're putting 12% or 6% into a future fund, but you're bleeding today. Like, I want to stop the bleeding today. Like, that's personally what I would do. That's what I did in my life. Like, I do put some money into a self-directed account, but it's more for deferred tax reasons now and for potential other things I can go and invest in on that side of things. But I'm putting way more into whole life to build my urgency, emergency, and opportunity fund, right? Like, the first thing we did was take back the high interest. So that's why I told them, like, if I was you, I'd find out if you stopped putting into the match. And I'm not telling you to do this, I'm not giving financial advice, but if you stop putting into the match, could you turn that back on in the future? Like, what would that look like? And then take care of this high interest debt, build the opportunity fund, and then go back, and because he's got plenty of time to worry about the future.
That's the thing. He has that time right now. So you'd have to just do the math on how much money you lose into the interest versus over here.
Yeah.
Well, cool. Do we have any other questions? Otherwise, if that's it, we will release you all.
Well, we made it already. That's kind of fast.
Yeah.
Sorry for my not having my full attention, but I've been answering questions because I just got backed up with questions I didn't even get a chance to answer today. So
that's a good one. David's saying, can you put in bi-weekly payments to fund your policy requirements? For example, on a 1,000 policy, to make 2 weekly payments or manual transactions to meet that requirement. So I think he's saying 500 every 2 weeks is what he's saying.
Generally not. The minimum mode is monthly on these policies, on any life insurance policy for that matter. Now, you did mention manual transactions. Not all carriers, but some do offer a manual monthly mode to where you can make manual payments rather than just the monthly automatic draft, and generally you're going to save some money on fees by doing the monthly automatic draft than doing the manual monthly payments. But I guess I'm kind of getting into the weeds here, but there's sort of a possible way for this to work. I'm thinking it's going to be better all around to, save 500 every 2 weeks into a bank account, maybe a separate bank account, and then have the life insurance company's automatic, withdrawal come out of that bank account, $1,000 once a month. But if it's too much of a stretch for that $1,000 a month for you to meet that, you may want to rethink, the monthly premium amount that you're comfortably able to fund. But yeah, I mean, there's more pieces to that part of the conversation too.
Yep, that's the same answer I give too. Well, awesome. Well, that's another Ask Me Anything in the books.
We got to get a number on this sometime, don't you think? How many we've done? Good job, all.
Yeah,
we've done it again.
I believe you can see it on the YouTube channel. I just haven't looked in a long time.
Good. I give you the task, if you want it, of figuring out where we are on that journey.
I'm looking right now.
There you go.
Well, everyone, we enjoy you being here. Bring your questions. Bring all of them next week. Bring someone with you. Bring a friend. Someone else that needs to know about this. Be kind. Invite them to come listen to this. If someone is a skeptic, invite them to come on. We'll have fun with them. I know we've got some real experts out there listening, like Chris and others. And we got a bunch of our clients that come, and a lot of people are traveling too. So just keep coming back. We'll be here next week. So
thank you, everybody.
Take care.